again, I think we need a couple of months of data telling us inflation has peaked and probably some visibility into when the Fed cycle will stop. Until then, I think we have a choppy market. So we're talking to clients about really managing risk, not taking any big tactical swings right now, and we're really erring on the side of higher quality investments until we get through this period.
And higher quality based on what factors qualify in terms of where you would like to have fresh money put?
I think you want to look at free cash flow. You want to look at strong balance sheets and companies and industries that have stronger earnings revisions. I would be balanced between defensives and cyclicals. I still like energy, especially after this reset, but I would have some defensives like healthcare, especially large pharma. I would also think about sectors like utilities to give me a balance between exposure to higher commodity prices that are likely here to stay and managing risk as we move ahead.
Let's bring in Victoria Fernandez, Crossmark Global's chief market strategist, and Scott Kroner, Citi U.S. equity strategist, to kind of kick around these same issues. And Scott, this is a big question, given where we are on the calendar in the earnings cycle, in terms of the outlook for economic growth, whether, in fact, corporate earnings and maybe downgrades to the profit outlook is the next shoe to drop, or has the market's behavior for 6 months been essentially telling you that this is already a foregone conclusion and maybe we've figured it out?
Well, I think they're both good points. I think that the valuation compression we've faced year to date has discounted some expectation for earnings risk ahead. Our view is that the earnings profile for the second half may actually prove more resilient than many are expecting right now. And the bigger earnings issue will be regarding 23 expectations, which probably aligns more closely with when a recession, if it does occur, were to occur.
All right. Victoria, we did obviously have the investors fixate to some degree this morning on that soft ISM new orders number, as well as employment. The Treasury's rallying very hard. It seemed like a very classic growth scare type dynamic, and yet the S&P 500 on the first day of a new month, we'll see if it carries through, but manages to get a 1% gain. And we're trading at levels on the S&P that honestly were first hit on the downside 6 weeks ago. Is that just grasping for the idea that we've priced a lot in, or do you think there's some merit to that idea?
Yeah, so, Mike, we don't think that we've seen the bottom yet. When we look at all the factors to try to determine that, we want to say, okay, have we hit peak yields? We're talking about the Treasury's really rallying. Well, we have cyclicals underperforming, defensives, you have banks underperforming utilities, you look at the copper-gold ratio. All of those things tell us that we should have hit peak 10-year yields or peak yields, and those are coming down, and we've seen that over the last couple of days. But we have to say, does that mean we're at a bottom yet? And I'm not sure. We haven't seen the big spike. It's actually down 6% today. We look at earnings expectations. We haven't seen those come in. We're talking about ISM numbers. Look at the PMIs too. Normally we want to see those under 50. And I think the biggest thing that we're looking for is that pivot from the Fed. And I don't think we're anywhere close to that. We've got to see services get hit a little bit, the growth in services. Look at real consumption for services we got this week. It was actually up 0.3%. So we're seeing the growth come down in goods. We're not seeing it in services. I think that's what we've got to look at. So some is priced in, but I think there's more to go to the downside.
Scott, on some very kind of broad top-down level, it certainly makes sense to sort of stay in a bit of a cautious stance, right? Just like last year, you could just say, hey, it's a bull market. Dips are to be bought. Liquidity conditions are very generous. The profit cycle's your friend. Don't overthink it. Overthinking it this year means don't fight the Fed, don't fight the tape. All rallies are to be sold. At some point, though, that sort of works itself through, and we're at a point where there's some kind of reason to think there's an inflection. What would you be looking for to say that maybe that scenario of resilience in the second half of the year is going to basically be persuasive?